Hey traders, in this video we'll talk about what is price averaging. Stay tuned. Hey traders, a very warm welcome to you. Okay, so what is price averaging, and more importantly, how do we use it effectively and not be dangerous with it? Because if you've heard about averaging down or averaging up, generally the connotations are, hey, this is a dangerous game, and it can be. And what I'm going to do in this short video is I'm going to talk to you about the difference between dangerously doing it and doing it in a structured way, and also what is it. So first of all, let's talk about what it is. So we have a chart here, and we have a stock, a futures contract, a currency pair. It could be anything, a generic market that moves down, it's moving down. And let's say our first purchase of this market is here. So that's buy level 1. And then the market carries on moving down and we buy some more. And this is at buy level 2. And it could move down further when you have 3, 4, 5, more multiples of buys. But the point is, what we're doing now is, let's say we're buying an equal number of shares here, or an equal number of contracts, or an equal number of position size, £10 a point. If we're doing spread betting, then our average price, or our position, is going to be here. So it's basically, it's just simple maths. You know, if we're buying a kind of 2, and then we're buying at 4. You know, what's our average price going to be? It's going to be 3, because if we're doing the same amount of contracts, if we did £10 a point at 2, £10 a point at 4, you know, our average price is going to be £20 a point if we're spread betting at 3. So that's pretty much what we're doing when we're averaging. And obviously it's going to be the other way around, but if you're going down, it's going to be 4 and 2. If you're shorting, it's going to be up, and you're going to be shorting at 2, shorting at 4, and average of 3. So that's what price averaging is. We kind of get that concept. I think most of us get that. But, you know, why do we do it? And what's the point in doing it? Now, there's two things with price averaging. One is the dangerous way, and the other is, I'm going to put deadly because it can be deadly. And the other is structured, right? Now, what I mean by those, the deadly way is when you say, hey, you know what? This price is going, this market's going down. I think I'm going to go long, and you buy. And then you think it goes down a little bit more, and then you buy, it goes down a little bit more, and then you buy, and you buy, and you buy, and you're buying and buying and buying as it's going down. You don't really have any justification for it. You just think it's going long. It's now way, way lower than your initial entry, and you're probably ended up with too much size. You might have added in more and more and more. Some people even add double, and you end up with a massive position. And you are ultimately going to be in your biggest position size in your worst trade. Now, the theory is, of course, is that if you're averaging down, and this is why people do it, is that it's bringing your entry down and your break-even point lower and lower and lower. You know, you're buying there, your break-even's there. When you buy here, your break-even comes down here. If you're buying then again there, your break-even's going to come to here. If you're buying here, it's going to come down there. But your position size is going to increase as you do it. So whilst you are bringing your break even lower and your sort of entry point lower, you're increasing your overall risk each time you do that. And of course, the scenario that you don't want to be in is you're doing that, and then, which is what happens to a lot of traders, the market then falls to the floor and does a final flush, and you are in a full boat because you've been adding way too early. You've got a big position size. Yes, your average is maybe midway between that, but you are in so much size that this thing is so painful, you have to cut it down here, and inevitably the thing bounces off. So, and that's a really painful trade, and one that takes you out and does a lot of damage to your account. So that's your unstructured way of doing it, and that's really not recommended. I know you can, the irony of this is, guys, if you time it right and you spread it out, you'll get away with that for a long time. You'll get away with that for a long time. Some of these guys who are doing kind of the social trading and what have you, years and years ago, were using this type of strategy, and the market conditions let them get away with it. They're adding. They had a pretty much unlimited bankroll. They're doing it on demo, and the market would rotate back and they'd come out with a profit, and it would all be looking very well, and they'd have 100% success rate. Of course, you know, the point is, if you keep doing it, the one time it just suddenly breaks loose and does something unusual, which markets do more often than you expect, you get absolutely hammered because you're in a massive size. So that's the unstructured and deadly way. Now let's look at the structured way, in a way that I think is valid, and a way that I use, and a way that I know a lot of traders use. So the structured way is to say, okay, we are now, let's use a different example. We're driving up to highs and I want to buy this as it's coming down here. Now, let's say the thesis of the trade is you're buying a pullback. Now, the important thing is with averaging into a trade is that we say to ourselves, you know what, I will average into the trade while the trade idea is still valid. In other words, if we're buying a pullback, where does the trade not become valid? It might be when it goes past the 50% of the drive level, maybe it's below the low, maybe it's whatever your level is, then there's no point. In other words, you're not going to be buying the thing down here with the same idea that I'm buying a pullback. You know, it's not a pullback anymore, it's a reversal. You're just now in a completely different realm and a completely different situation. So what you might do in a structured way is you might say, okay, I'm going to buy a bit here on this pullback. If we lift up a bit and come down and test again, I'm going to buy another batch here. Maybe I'm going to buy another batch here. I'm going to buy up to a set amount of position size. So your position size is X. You're going to split it up in a structured way into 3 or into 4 and say, you know what, I'm going to stagger my purchases like this. And another, actually probably a better example would be, hey, if it's a fake out, so we've got a kind of support level here, price goes down and we're looking to buy at support. Maybe we buy our first batch at support. Maybe it comes through, we buy a second batch underneath. Maybe it kind of congests a bit, we buy a third batch, and the idea is we assuming it's a fake out, I'm going to hold, and then it pushes back up. It's very structured. We know exactly what our position size is going to be. We know roughly our worst case scenario price, average price, and so we can manage our risk still with it. And you can see the difference between that and just scaling in blindly when price is going lower and lower and lower and you're adding and adding and adding with no structure to it. You don't know where it's going to go. You've got a massive size. You've got no control of what's happening. You know, this is far more structured. You're already saying, hey, my maximum size is X. My average level is going to be X. My stop is going to be here. My total risk is going to be this. And sometimes you may not get your full size on. You know, you may get your first scale here and it pushes off. You may get your first buy here and it pushes off. And that's fine, you know, that's part of the concept and part of the game. And then you might end up scaling into a position, which is another topic altogether. But the point is, keep away from the deadly way and use the structured way. And actually the structured way works nicely because sometimes it's difficult to pinpoint that exact turning point. And if you stagger your position out and kind of scale into it around, you know, an area, then you might often have better results. But okay, consequences are you could be in, you know, the smallest position size when you're right first time. You know, there's never a golden bullet, guys. There's never a kind of silver bullet or a holy grail, if you like, to trading. There's always pros and cons to it. But I think the main thing is just stay away from the deadly one. If you're doing that and getting away with it, just have a little think and think, how long can I get away with that? What could happen? I could be in a full position size and the thing goes crazy and that's game over for you. But structured one, pretty good to look at and maybe integrate into your trading plan. Anyway, guys, if you like the video, thumbs up. Take care. See you in the next one. Bye-bye.